You know, it often feels like banks have some kind of superpower, a way to take the money you deposit and just multiply it across the entire economy. It sounds a little bit like magic, but honestly, it's one of the most important ideas in all of modern finance. Okay, let's get right into it.
So let's kick things off with a big question. Imagine you walk into a bank and you deposit $1,000. Is it actually possible for the banking system to take that one deposit and, through a series of steps, turn it into $5,000 of total money? I mean, that sounds impossible, right?
Well, believe it or not, the answer is a resounding yes. And no, it's not magic. It has a name. It's called credit creation. This is the process where banks literally create new money, not by printing bills, but by lending it out. So how on earth does this actually work?
The secret to this whole thing, the ingredient that makes it all possible, is something called the fractional reserve system. Once you get your head around this one core principle, the rest of it just clicks into place. Okay, first things first, we gotta bust a really common myth. A bank isn't just a giant piggy bank that holds onto your cash. That's not its main job. The real business of a bank is lending. When you deposit money, they are actually required to lend most of it back out.
Now, of course, they can't lend out every single dollar. Central banks set a rule, and it's called the legal reserve ratio, or LRR for short. Think of it as the minimum percentage of all deposits that a bank has to keep on hand, in reserve. This is to make sure they have enough cash for people making everyday withdrawals. So, to make this all crystal clear, we're just going to pick a simple number for our example. Let's say the legal reserve ratio is 20%. What this means is for every dollar you deposit, the bank has to keep 20 cents, but it can lend out the other 80 cents. This one little number is the spark that starts the whole chain reaction.
And this is where it gets really cool. We're going to watch this 20% rule create a domino effect across the whole banking system. You're about to see exactly how that initial $1,000 deposit starts to multiply.
So here's the basic loop, the blueprint, if you will. It all starts with that first deposit. The bank holds back its required reserve, the 20%, and then loans out the rest. And here's the crucial part. That loan gets spent, and whoever receives that money, well, they deposit it into their bank. And just like that, the cycle starts all over again. All right, check out round one. You make your initial deposit of $1,000. The bank, following that 20% rule, has to keep $200 in its vault. That leaves $800 that it can and does loan out to somebody else. And right there, that $800 loan is essentially new money that's just been created in the economy. But wait, it doesn't stop there. The person who got that $800 loan spends it, and the recipient deposits it into their bank account. Boom, round two kicks off. This new bank now has a fresh deposit of $800. It keeps its 20%, that's $160, and loans out the rest, which is $640. You can already see the snowball effect starting to happen. And this just keeps going and going and going. That $640 loan is spent and deposited, creating a new loan of $512, and on it goes. Each loan gets a little smaller, sure, but when you zoom out and add it all up, look at those totals. That initial $1,000 ends up supporting a grand total of $5,000 in deposits, creating $4,000 in brand new loans. I mean, that's just wild when you think about it. Our original $1,000 didn't just sit there. It became the foundation, the seed money, for $5,000 circulating throughout the entire system. The money was literally multiplied 5 times over, created purely from the act of lending. Now, adding up that entire chain of loans every single time would be, well, a bit of a pain, right? Thankfully, there's a really neat and powerful shortcut, a formula that can tell you the final result instantly.
And here it is. It's called the Money Multiplier. The formula is beautifully simple. It's just 1 divided by the legal reserve ratio. This little equation is the engine that drives all of credit creation. It tells you exactly how many times that first deposit can be multiplied.
So let's test it out with our example. The LRR was 20%, or if you write it as a decimal, that's 0.20. So we plug that into the formula. 1 divided by 0.20, and what do you get? You get 5. The money multiplier is 5. It works perfectly. And now calculating the total is just dead simple. You take the initial deposit, in our case $1,000, and you multiply it by the money multiplier we just found, which is 5. And voila! You get a total of $5,000 in deposits. The exact same answer we got from that big table, but it took, what, 5 seconds? So, okay, this is a cool economic trick, but so what? Why does any of this actually matter in the real world? Well, if you understand the money multiplier, you understand one of the main ways that central banks can steer the entire economy.
Because if that legal reserve ratio controls the money multiplier, then changing the LRR gives a central bank an incredible amount of power. It's like having a master control knob for the flow of money and credit through the whole economy.
And the key thing to get is that it's an inverse relationship. Think about it. If a central bank raises the reserve ratio, they're forcing banks to hold on to more cash. That means less money is available to be loaned out, which shrinks the money multiplier and helps to slow the economy down. But if they do the opposite and lower the reserve ratio, well, now banks have more money to lend, the multiplier gets bigger, and that helps to stimulate economic growth.
And that brings us to a final, pretty thought-provoking question. We've just seen how most of the money in the economy is actually created digitally, as credit, by commercial banks. So if that's true, what is the point of a central bank actually printing physical cash? It turns out it's a much smaller piece of a much, much bigger puzzle.